In a brilliant move, Caleb Williams tried to avoid taxes by asking the Chicago Bears for a very unusual contract structure. Let me tell you what he did. So apparently during the contract negotiations, Caleb Williams asked the Chicago Bears to pay him as an LLC. This would have gave him some serious tax benefits. But guess what? The NFL wasn't having it, which basically means what I think is a brilliant request hit a dead end. But what if there was another way Caleb Williams could get similar benefits and tax advantages? So let's take a look at successful coach Jim Harbaugh, who recently just won the national championship, coaching for the Michigan Wolverines, and just signed a contract to coach the Los Angeles Chargers. So when Jim Harbaugh took his head coaching job at Michigan, the university actually agreed to compensate Jim Harbaugh in the form of a life insurance loan. This is what's called a split dollar arrangement. Now let's break this down step by step to see how Jim Harbaugh structured his deal with Michigan and how it could work for other athletes like Caleb Williams. This represents the agreement between Jim Harbaugh and the University of Michigan. The contract details outline how the split dollar arrangement will work, which includes the loan amounts and the terms of the agreement. The policy that Jim Harbaugh owns is an index universal life insurance policy. This is a policy that has a cash value and a death benefit. This is the core of the split dollar arrangement. The University of Michigan then provides loans to cover the premiums of the policy. These loans are typically interest bearing and are meant to be repaid from the policy's death benefit. Harbaugh then takes the money loaned from Michigan and he uses that to pay the premium of the Index Universal Life policy, which grows at an average rate of 6 to 10% per year. Harbaugh can loan against his policy's cash value at a 5% loan rate. This means that even though he's borrowing money, he's still earning a positive spread on the cash value in the policy. These loans are tax-free and they can be used for anything like paying his expenses, making investments, or even funding his retirement. Now, upon Harbaugh's death, the life insurance policy pays out a death benefit. The first part of that death benefit goes back to Michigan to reimburse them for the loans and the interest that they advanced Harbaugh. The remaining part pays tax-free to Jim Harbaugh's family. So just pause for a moment and imagine the flexibility this offers. Harbaugh can take loans from the policy's cash value without paying taxes on the amount borrowed. This provides a stream of tax-free income that he can use however he sees fit. Now, if Caleb Williams could negotiate a similar deal with the Bears, he'd enjoy similar benefits: tax-free loans from the policy's cash value, tax-deferred growth of his investment, and financial security for his family. Meanwhile, the Bears would recover their investment from the policy's death benefit. So while the LLC payment idea didn't work, a split dollar arrangement could be a game-changing alternative for Caleb Williams and the Chicago Bears. It's a win-win for both parties. If you thought this was really interesting, follow me for more tips on how you can eliminate debt, avoid taxes, and build generational wealth.